Jake Claver just dropped what could be the boldest prediction in XRP's history. And this time he's not backing down. The countdown is officially on, and according to him, the market is about to witness something no one's ready for. A potential $750 XRP by year end. And the structural events behind it might already be unfolding. Now, before we dive into this, a quick reminder. This is not financial advice. Always do your own research and consult a professional. Everything discussed here is based on documented research, macroeconomic analysis, and verifiable data. If you value content that cuts through speculation and brings you clarity about what's really happening underneath the surface, tap the like button, subscribe to Matrix Millionaire, and drop your take in the comments before the end. It helps more than you realize. Alright, let's unpack why this call isn't as impossible as it sounds. Claver isn't a hype merchant. He's a structural analyst who's been mapping liquidity, derivatives, and macro debt flows for years. When he says something like this, he's not talking about memes or speculative pumps. He's talking about how value actually moves through the plumbing of global finance. He calls it the liquidity realignment phase, the moment where old rails crack under pressure and new systems built on digital settlement infrastructure quietly take over. According to him, XRP sits at the center of that transformation. His reasoning starts with the math of liquidity. Right now, XRP's total supply stands in the tens of billions, but the effective circulating float, the portion that actually trades freely, is far smaller once you account for Ripple's escrow, custody holdings, and dormant wallets. If ETFs and institutional liquidity products begin absorbing even a fraction of that supply, the available tokens collapse towards scarcity overnight. That's when the market structure flips. Because in every major monetary transition, scarcity isn't a byproduct, it's the trigger. When demand scales through regulated instruments, supply compression becomes unavoidable. And the liquidity shock that follows doesn't just move price. It reprices the entire network's role in global finance. This is the foundation of Jake Claver's $750 thesis. He believes XRP's price will no longer be driven by retail speculation, but by institutional throughput, the amount of value moving through its rails each day. To understand that, you have to step back and look at the broader system. Right now, central banks are caught in what he calls a synthetic liquidity trap. Bond yields are climbing, debt costs are surging, and legacy settlement systems can't recycle capital fast enough. Every extra day that money sits idle between trades, it costs someone yield. And that's what XRP's architecture eliminates. This isn't about crypto hype, it's about efficiency arbitrage. When value moves instantly instead of waiting 2 or 3 days for confirmation, capital rotation accelerates and every institution gains an edge. In that race, slow liquidity dies. So when Claver ties his projections to structural catalysts, ETFs, bond instability, the reverse carry trade unwind, he's describing a moment when the global market stops chasing yield and starts chasing settlement speed. You can already watch it forming in real time. The best place to see it, MEXC Global. It's one of the few exchanges where you can actually visualize liquidity migration. How institutional money begins positioning before the broader market catches on. When the XRP USDT pair volume starts expanding quietly. It's often a precursor to capital rotation happening under the surface. That's how smart money moves. Silent, early, and without announcement. If you want to see the data as it happens, the link is in the description below. And that's where XRP enters the picture. Imagine a financial system that no longer depends on delayed trust, where banks, ETFs, and even sovereign funds can settle instantly across tokenized assets. When that happens, the rails capable of handling those transfers become the most valuable real estate in finance. XRP, with deterministic finality and near zero friction, is built precisely for that function. Now, Claver's new twist, the one shaking everyone, is the derivatives phase. He believes the next wave of integration isn't just payments or remittances. It's the absorption of global derivatives and collateral settlements onto blockchain infrastructure. The notional size of that market runs into the hundreds of trillions. But what matters is the collateral actually exchanged, the real settlement layer. If XRP captures even 1% of that, you're no longer talking about double-digit or triple-digit valuations. You're talking about redenominating liquidity itself. And that's why this prediction feels so outrageous to outsiders, but completely logical to those tracking the mechanics. Because once tokenized treasuries, ETFs, and digital bond markets start running on distributed settlement rails, the price per unit of liquidity has to adjust to match throughput capacity. In simple terms, the fewer tokens available, the more each token must be worth to handle global volume. That's the same logic that took Bitcoin from pennies to tens of thousands of dollars. Except now we're applying it to an asset built for institutions, not speculation. So when Jake Claver says 750 by year end, what he's really signaling is that the infrastructure is ready. ETFs are entering, liquidity is migrating, regulation is aligning, and the network effect is activating. The world is shifting from storage of value to motion of value, and XRP is the motion layer. If you understand that, then you understand why this is more than just a prediction. It's a reflection of the system rewriting itself in real time. We'll break down exactly how these institutional flows, ETF mechanisms, and the hidden liquidity rotations behind the scenes could trigger the supply shock Jake's describing, and why he calls the coming months the ignition point for XRP's global repricing. The system is whispering before it roars. Behind the daily noise of charts and speculation, a chain reaction is already forming. One that could pull XRP from quiet consolidation into the center of a global liquidity reset. The first spark comes from institutional access. Once a regulated spot ETF is approved, liquidity migrates automatically. Pension funds, family offices, and asset managers no longer need private custody. They can gain exposure through traditional channels. That single structural change flips XRP from a speculative asset to a regulated liquidity instrument. When that happens, it creates what analysts call a supply cascade. Exchanges compete with ETF issuers, custodians, and liquidity desks for the same limited pool of tokens. The moment the first large allocation locks into ETF storage, circulating supply on retail markets evaporates. That's how scarcity transitions from narrative to measurable data. Then comes the bond market catalyst. As sovereign debt costs keep climbing, central banks and institutions are under pressure to recycle collateral faster than ever. Traditional settlement systems, SWIFT, Fedwire, CHAPS, are too slow for the velocity modern markets require. Each delayed transfer is lost yield. That inefficiency is exactly what distributed settlement networks, especially XRP's architecture, were built to fix. In a world where every fraction of a second translates to millions in opportunity cost, instantaneous settlement isn't optional, it's survival. And that's why the migration won't wait for headlines. It's already underway. You can actually see the early footprints of this shift if you know where to look. On Mexi Global, liquidity behavior is starting to change character. Deeper order books, sharper spikes in XRP USDT volume, and cross-pair arbitrage patterns that usually appear when institutional desks begin testing market depth. These aren't day traders, they're liquidity engineers. Each adjustment in that data points to capital rehearsing for a larger move, a quiet rehearsal for a future where XRP acts as the settlement layer of real-world assets. Next, the derivatives ignition. Every time volatility expands in debt and equity markets, derivatives volume surges. That market, valued in the hundreds of trillions, is built on collateral rotation, contracts that settle daily across borders. The current infrastructure can't handle that scale in real time. But XRP's deterministic finality can. Even a 1% migration of derivative settlement into on-chain systems would inject trillions in throughput. The result? A permanent re-rating of XRP's functional price floor, not a temporary spike. And finally, the reverse carry trade unwind. When institutions unwind positions that were funded by cheap foreign debt, they need immediate liquidity to cover exposure. Those flows often trigger currency volatility, the exact environment where a neutral settlement asset shines. If that liquidity migrates toward faster rails, XRP becomes the logical bridge asset between currencies, nations, and asset classes. Each of these catalysts alone could move price. Together, they create a synchronized mechanism, a flywheel that accelerates once ETFs, bond compression, and derivative integration overlap. That's what analysts refer to as the ignition point. It's not a date, it's a condition. The moment when institutional liquidity density overwhelms retail supply. At that point, the market doesn't pump, it reprices. Because in a network where value moves instantly, equilibrium must rise until the available float can support global transaction volume. That's the liquidity shock Jake described. Not hype, not guesswork, but the mechanical outcome of too little supply meeting too much velocity. And when that moment hits, it won't announce itself. There won't be breaking news or coordinated tweets. It will look like an ordinary day until it isn't, until price gaps upward and never returns to its previous baseline. Every market shift begins with silence, not noise. Long before headlines catch on, before the public starts talking about breakouts, the professionals are already moving. They don't chase volatility, they design around it. Right now, the market feels slow, flat, almost uneventful. And that's exactly how systemic repricing begins. Retail looks away. Volume cools. Sentiment fades. Meanwhile, the deeper liquidity pockets start rotating capital not into hype tokens, but into settlement infrastructure. You can see it in the patterns. Small sell-offs absorbed instantly. Gradual wallet accumulation. ETF applications filed during low volume weeks. These are not coincidences. They are coordination signals. The people who control capital don't move emotionally. They move strategically while the rest of the world gets bored. That boredom is the camouflage, because the longer price stays quiet, the more it allows institutional allocations to load in unnoticed. By the time the average investor realizes the trend has shifted, the supply is already locked. That's when the narrative flips from disbelief to panic buying, and that's where fortunes are made or missed. Understanding this isn't about guessing price targets. It's about recognizing behavioral timing. Every liquidity cycle ends the same way. Disbelief, accumulation, repricing, then validation. XRP is following that script almost line by line. Look around. Bond yields breaking patterns. Central banks hinting at settlement reform. Tokenized assets entering mainstream custody frameworks. And in the background, Ripple's infrastructure connecting those dots quietly, efficiently, without asking permission. This isn't the hype phase. It's the operational phase, the point where speculation fades and architecture takes over. The rails are being welded together while most of the world argues about headlines. When this flips, it won't look like a pump. It'll look like inevitability. The market will stop. Treating XRP as a risk asset and start pricing it as financial infrastructure. The same way we once priced gold, oil, or treasuries. Based on utility, not opinion. And when that happens, the noise stops. Value moves where it's respected, not where it's shouted about. So if you're still watching right now, that means you understand what most don't. That what's unfolding here isn't just another crypto story. It's a liquidity transformation that redefines how money moves, how collateral is settled, and how nations interact financially. This is the era where speed becomes sovereignty, and whoever controls the flow controls the future. If this opened your eyes, if it made the bigger picture click into focus, then do one thing right now. Like this video, subscribe to Matrix Millionaire, and comment the word asset. That single word tells me you stayed till the end, that you see through the noise, and that you're part of the movement that's decoding the future before it arrives. Stay disciplined, stay informed, because when the floodgates open, it won't be random. It'll be everything we've been preparing for. See you in the next one, my